Some very interesting news just came out from West Virginia about the potential opioid liabilities on the balance sheets for McKesson and Cardinal Health. And it could actually potentially be some very good news. And so that's what I want to cover in this video. So guys, smash that like button and subscribe if you're new. You're watching More Money. Let's get it. What's up guys, welcome back to the channel where the goal here is to help at least 1,000 people achieve financial independence much sooner. And let's dive right into this one because this one's very interesting. So you can see here, a federal judge just ruled that Cable County and the city of Huntington did not show that actions by the 3 drug distributors caused the opioid crisis. And this is a very interesting concept because in the US, there was a huge opioid crisis and there continues to be one. But my question is, do the distributors have a liability here? Well, many courts have said that they do. And so Cardinal Health, McKesson, they've all set up these big liabilities, like billions of dollars to address it. But the question is, if the drugs are legal and they're being prescribed, Cardinal Health and McKesson and those types of companies, these logistics transporters, they get put in this interesting situation where should they now start not transporting certain drugs that they feel are harmful to society, irrespective of the fact that they're completely legal at the time? It puts them in a weird little situation. And so I think the people that should be taking the biggest liabilities personally are the people that knowingly pushed this stuff and developed it, not necessarily the trucking companies that took it there. But I might have a minority opinion in this situation. But let's dive into the article and see what they say. U.S. District Judge David Faber rejected arguments by Campbell County and the city of Huntington that the distributors should be held liable for the public health crisis because they ignored evidence that prescription drugs were being diverted for illegal use. And so I guess this is a little bit different from what I just mentioned because this is an even tougher situation. So do you just not distribute drugs when you feel as though those drugs could potentially be used for illegal use? Like, here's the thing. Tylenol 3s is an example. Do you just not distribute Tylenol 3s because some of it could get stolen at a certain point in the distribution chain and be sold into sort of like the black market for use? Like, do you just not transfer these products as a result? I feel like it puts you in a really tough situation as an organization. And for those people who say that, yeah, you should be held liable, then the question is, what sort of reasonable procedures should be put to make sure that they're only transporting drugs that will not expect to be sold in the black market? So that's kind of the way I'm thinking about this, but I might not completely understand the situation. So let me know in the comments what you guys think, and should these companies be held for this type of liability? And note that the 3 distributors actually sort of signed off on this liability because them, including Johnson & Johnson, agreed to pay $26 billion to settle claims nationally. But West Virginia communities opted out of that deal to sort of go their own way. And this is what I was talking about. Pharmaceutical distributors like AmerisourceBergen have been asked to walk a legal and ethical tightrope between providing access to necessary medications and acting to prevent diversion of controlled substances. And sort of where is society really falling on this? Well, you can see in Orange County in California, they rejected arguments that the 4 drug makers helped fuel the opioid crisis. So even in California, at least in that specific county, they're saying that these distributors did not help to fuel the opioid crisis. In New York, they actually favored in favor of the communities and said that they found Teva Pharmaceuticals liable in creating a public nuisance. So it's a real hit or miss depending on which court you get and what they sort of decide. Now, like I said, I fall on the side where I just don't think that the distributors are liable. But once again, I might not have full information. And so there might be more information here, which is causing some of these courts to say, yeah, you guys did push this sort of like public health crisis. But the point of this video isn't to argue whether or not this is ethical or whether or not they're liable. The point of this video is to show that there's only upside from my perspective. Now, they've already pretty much settled their class action suit, but I personally believe that these companies have over accrued these liabilities. And here's what I mean. Cardinal Health has a class action liability set up in their long-term liabilities. And I believe that there's only upside from this because, once again, I believe that they've over accrued for opioid liability. So here's what they've done. As part of the settlement framework, they've put together a cash component, which means that they'll pay up to $5.56 billion over 18 years. And their total accrual is $6.68 billion because they're going to help in sort of programs used for sort of opioid treatment and sort of like preventative measures. And so where does this liability fall when it comes to the valuation of Cardinal Health? You can see from my excess capital valuation or calculation, you have $3.4 billion of cash on the balance sheet. And then within that long-term debt number, that's where you have the liability valued in. And so I'm actually saying despite them having excess cash on the balance sheet, they have a net negative excess capital amount because we're factoring in that liability. Now remember, that liability is not being paid today. It's being paid over 18 years. So I'm being very pessimistic in my valuation for Cardinal Health. And how pessimistic does that make my valuation? Well, the EPS valuation is suggesting that the company's worth $82 per share, and the excess cash calculation is reducing that valuation by $10 per share. So I'm valuing the company at approximately $72 per share, and comparing that to the current share price of $53 per share, you can see that there isn't a huge discount as a percentage of their overall valuation. Now, this is more of a stable type company. So if you're able to buy Cardinal Health at 75% of their intrinsic value, I think it's a pretty good area to purchase the company shares at. And the other thing that you can do is you can potentially sell cash secured puts that'll bring your net purchase price much lower, but you're able to enter into a wonderful opportunity. This is something that I actually did last year. Ended up making quite a bit of money from Cardinal Health. And as the share price continues to decline, I might consider to do it again. And with McKesson, you can see the same thing. I may have penalized them too much for the debt here because I'm saying that despite them having $3.5 billion of cash on their balance sheet, I'm saying that their excess capital is negative $11 billion. And so what does that mean for the valuation? Well, you can see that I'm valuing the company at 12.5 times earnings at about $400 per share, which compares to the current share price of $300 per share. But because I've penalized them for that opioid liability, you can see that their free cash flow per share valuation is actually $300 per share, $330 per share, which effectively reflects the current share price. And so I believe that they're pretty fairly valued, which you can see if you just look at the share price action for McKesson. It's really run up, because I think the value investors since last year identified this opportunity at around the same time where I put out the video on Cardinal Health, and they started buying it up. And so where do you get access to these models? And so you can decide for yourself how you value these companies? Well, you can get access to all the models at the lower tier of the Patreons. And there's an epic live presentation each month where my very best work is reserved for the call. And in that call, we'll go over sort of the details of these particular opportunities that we're seeing, sort of talk about where we may disagree and agree. I always give the Patreons an opportunity to sort of challenge the valuations. And so it's very interesting and a very informative call. And so if you want access to that, it's all available at the higher tier of the Patreon. And once again, like I always say, there's never any risk to you, because despite what Patreon tier you take, if you decide that it's not for you, just let me know in the Patreon app and I will completely refund that first full month subscription. And so there's never, ever any risk to you. And now the other opportunity that I want to sort of bring to your attention is Warren Buffett continues to buy Occidental Petroleum. And there are suggestions that he could actually take over the whole company. But in addition to that, Occidental is actually buying back at least $3 billion in shares, which reflects 6% of the overall organization. So you have buying pressure from Buffett and buying pressure from Occidental Petroleum, which provides you an opportunity for some really healthy yields on the cash secured put front, which on a net purchase basis would allow you to buy the shares for Occidental lower than what Buffett is buying them. And I covered that whole opportunity right here.